David and I hope you're having a fantastic day. Today we're going to talk about making sense of volatility.
Volatility is a word that you'll often hear if you tune into BNN or any of the many news outlets that cover the investment markets. Volatility is defined as the degree of variation of a trading price series over time as measured by the standard deviation of logarithmic returns. Or in plain English, you can think of volatility as the degree to which the price of an asset fluctuates, and that fluctuation can be measured daily, weekly, monthly, or yearly. When stock markets are up significantly one week and down significantly the next, we would say volatility is high. When stock markets are relatively unchanged from one week to the next, we'd say volatility is low. Volatility is a normal part of investing, and unfortunately it can't be avoided if you wish to grow your savings at a rate that's faster than you could with a GIC or a savings account. One of the most fundamental pillars to being a successful investor is being mentally prepared for volatility. Watching your portfolio go up 10% in a year is easy for anybody to do. But watching the value of your portfolio drop 10% in a year is really challenging, and some investors aren't equipped to meet that challenge. Knowing what level of volatility you are comfortable with is an important thing for every investor to figure out before they make an investment choice.
This is a great chart that David and I have used many times in meetings over the years. Maybe you've seen it before yourself. This chart looks at the TSX, which is a benchmark index for the Canadian stocks. It shows you the actual annual return the index earned in any given year going back to 1980 and the largest top to bottom drawdown during each year. Over the past 38 years, the TSX has posted positive annual results in 27 years, or 71% of the time. What's interesting to note is that even in a great year like 2009, where the market made 35%, there was a period during that year where the market temporarily dipped by 9%. This goes to show that even in good years, as an equity investor, you are likely to experience a painful month or quarter of volatility. What we like about this graph is that it does a good job illustrating the volatility profile of stocks in general. As you have seen before with our three-ball strategy, stocks, which are represented by the top ball, have significant levels of volatility. Our rule of thumb for investing in stocks is that you should be prepared to make upwards of 40% in the best years, but also prepared to lose roughly 30% in the worst years. If you are not comfortable with this level of volatility, then you should not have all your money invested in stocks.
Okay, so we know that volatility comes with the territory when investing in assets like stocks and bonds. But what should investors like yourself do when confronted with volatile markets? Harry and I think that there are 3 simple steps to successfully navigate a difficult market. The first thing is to always remind yourself that volatility or ups and downs in your portfolio value is very normal. It's also natural to feel uneasy or worried by a drop in value and to feel like you need to do something about it by taking action and perhaps selling an investment. In reality, what you should do when you feel uneasy or worried by a drop in value is meet with Harry or myself. We'll review your portfolio with you and go over what it is exactly that you're invested in and why it belongs in your portfolio. We'll make sure that your investments continue to be suitable for you in relation to your cash flow needs as outlined by your financial plan, and also in relation to your comfort with risk as outlined by your investment policy statement. The last thing to do, which is often the hardest, is to trust the professionals you have working for you. The underlying assets inside your portfolio are actively managed by some of the best money management teams in the world. These teams have direct access to the directors of the companies that they invest in, which helps to keep their finger on the pulse. They also have the ability to analyze huge amounts of data that the regular investor just simply can't do on their own. They employ strict buying and selling criteria in their investment process, and so they don't panic when they're faced with volatility. In fact, effective portfolio managers take advantage of volatility and find opportunities. This is a continuous and ongoing process that ensures the investments you own are always worthy of your hard-earned money.
David, excellent points about volatility and how the money managers take advantage of them.
As always, if you have any questions about your portfolio, Harry and I would love to get together with you to review.
Take care.